If you are an NRI living in a zero tax country like the UAE, here is a question that can decide your long-term wealth. Should you invest in Indian mutual funds for that high local growth, or stick to global markets like the S&P 500 to benefit from INR depreciation? Let's break this down simply. Historically, S&P 500 has delivered around 10% annually in USD. Now add to that, the Indian rupee has depreciated by around 3 to 4% per year against the dollar over decades. Now combine the two, so your INR adjusted returns becomes around 13 to 14% annually without even touching Indian market. Now Indian diversified equity mutual funds have given a return of around 11 to 13% annually in INR terms. Sounds good, but here's the catch. When you adjust for currency movements, the gap isn't that huge. And if the rupee temporarily strengthens, your foreign currency returns can actually drop. So liquidity is the game changer here. If you invest globally, then your funds are in USD and can move across countries instantly. No paperwork, no restrictions, nothing. But if you bring money into India now, taking out later means filling out forms like 15CA or 15CB filings. Plus, you will need bank clearances, annual limits will come into play, and TDS of course. Also at taxation. Living in Middle East means zero capital gains on global investments. But Indian mutual funds, you still pay capital gain tax in India even if you're abroad. So if your return to India is still uncertain, keeping your investments global, especially in USD assets like S&P 500, I think that can give you growth, currency benefit and full flexibility. But when your return becomes certain, start shifting gradually to India to manage currency and market timing risks. Just one wrong move here can cost you years of returns. So don't follow hype, just follow your strategy.